All right. Well, welcome all of you this morning, and good morning to all of you. We'd like to thank you for joining our webinar today, Constructing Your Best 2023, What Contractors Can Do Today. And this is all about you, the contractor or the service provider to the contractor. So make sure to make this as interactive as possible. Ask us all the questions you can. We have a great group of people speaking today and presenting topics for you. My name is Dennis Dlugosz. I'm a director at Corrigan Krause. In our tax department, I lead our construction services group, and I will be guiding our discussion today. Thank you for taking the time to join us, and we hope that we're able to help you construct your best 2023. Our goal for today is so you can take away with some actionable items to help you build a strong plan for 2023 as you wrap up 2022. Can't believe that we're already in Q4, wrapping up this year. It's gone by fast on here. We have 4 speakers today: Kevin Keller of the Fedeli Group, Phil Truax of Truax Law Group, and he specializes in construction law, Joe Kalkstein and Whitney Brady of Alliant Group. I'm going to have everyone give a brief introduction, and we'll go over a few housekeeping items, and we'll jump into our discussion for today. So Kevin, why don't you tell us a little bit more about yourself and how the Fedeli Group helps construction companies.
Thanks, Dennis, and good morning, everyone. Thanks for joining us. I've been in the bonding business for 36 years. I worked for the Fedeli Group. I was part owner of my own agency for 10 years prior to being bought out by Fedeli. What we do, we think that we do a little more than just type up bonds and send them out. We like to feel like we're part of your team, part of your professional service team, along with your insurance agent, your CPA, your accountant, other professionals that you do business with. We just want to be part of that team and help have input. What we do for contractors is we really try to understand your business plan, understand where you're going, and to try to match you up with a surety company that is a good fit for you.
All right. Thanks, Kevin. Phil, how about yourself?
Thanks, Dennis. Hi, everybody. Welcome to our webinar this morning. Happy to have all of you here. Phil Truax of the Truax Law Group. I've been a construction attorney for about 17 years. Spent about 5 to 6 years actually working in the field during my college and law school days, and spent the majority of my law career working in the construction. Had the privilege to work with a number of great construction attorneys in Ohio. Primarily focus on the folks doing the work, the contractors, the subcontractors, the material suppliers. Do a lot of work, everything from helping with agreements and helping manage risk during projects and before projects, and then getting involved in trying to resolve disputes. And we do a lot of work with companies' corporate issues and transactional issues as well. But happy to be part of this team here today, and happy myself to learn a little bit about what our other panelists are going to have to say and how we can better help all of you as attendees for today's program.
Thanks, Phil. Our next people to introduce will be Whitney Brady and Joe Kalkstein. Whitney's a little under the weather, so you won't see the best looking panelist on the screen today. So I think we'll have Joe have to fill in for big shoes to fill. But Joe, can you tell us a little bit about yourself, Alliant Group, and also how you guys work closely with construction companies?
You bet. Thanks, Dennis. Thanks for having us. Welcome to all our attendees. Good morning, Phil. Good morning, Kevin. We're Alliant Group. We are a specialty tax consulting firm. I am a technical director, and I've been helping U.S. companies claim government incentives for about the last 15 years. Our mission is pretty simple: help business owners take advantage of the dollars and the funds that are available from our federal government. And we're really excited to share our expertise today in one specific area that has been really beneficial for construction companies.
Awesome. Thanks, Joe. And thanks, Whitney. And thank you guys for coming on. We're all local, Phil, Kevin, and myself. And Joe got up an hour earlier today because he is in Texas. So thank you to Joe for getting up a little earlier for us.
All good. I have two small children. It's it's all good. Yeah,
get out. You already were up. A couple housekeeping items. Interactive discussion. So make sure to ask questions. Remember, this is about the people that are on here listening. We want to make sure that we answer any questions that we can. We will be recording this, and also the PowerPoint will be distributed to all attendees on here. And don't forget to sign up. If you can go to Corrigan Krause, our website, and sign up for our construction services newsletter that we send out. You'll find a lot of good information and some more information probably about people on our team in the construction area. So today, all about wrapping up 2022. Again, Q4, getting ready for 2023. And there's a lot of stuff going on here. So it's going to be a great update to listen to see what else we can do out there. And especially with our first presenter, our Kevin, because there's a lot going on in his insurance market, because a lot of it's dictated by government policy, interest rates, inflation, and all those items that we all hear about every time when we turn on the news on there. So Kevin, what can our clients do today to make sure that their bonding capacity is at its maximum going into 2023?
Well, Dennis, your timing for that question couldn't be better. We're right at the end of the year. It's that time of the year where contractors and other businesses are thinking about their year end coming up. I would like to just harken back to a quote from Will Rogers. He said, "You never have a second chance to make a good first impression." And that's really what you're doing with your year-end financial statement. It's a snapshot of one day in time. So why not make that snapshot as good as possible? There's some things that you can do that can help you as a contractor going into 2023, give you the strongest balance sheet. And sureties look at working capital as the primary driver of bonding capacity. So that being defined as current assets minus current liabilities after some adjustments that might be made to certain assets. So as we get to the end of the year, we want to do some things that will help our balance sheet look better when we finally do it at December 31. We know that the surety is going to make some adjustments to your financial statements. For instance, they're going to typically ding if you have marketable securities, they're going to be reduced by 15 to 25% to account for fluctuations in the securities market. We know that over 90 receivables are going to be heavily scrutinized and possibly excluded from the working capital equation. We know that inventory is reduced by 50%. Prepaid expenses and shareholder loans are typically excluded completely. So these items, you want to try to clean these up before year end. If you're thinking about, you want to have more cash, maybe you can be in cash instead of marketable securities. But here's a couple of tips. You want to consider paying late year payables on the first day of the next year instead of paying all your payables at the end of this year. Now, for cash basis taxpayers, it's a totally different game. But I'm talking primarily about the larger companies who have moved beyond cash basis tax. You might want to not prepay a bunch of expenses. You may have an insurance bill for your entire insurance for the next year. Well, you don't want to pay that in December if you can avoid paying that. You might want to do that and maintain your cash and pay that in January. You don't want to buy a bunch of inventory before the end of the year if you can buy that same inventory in January. If you have borrowed money from your company, you want to try to pay it back. Or if you have affiliated companies with intercompany receivables to your primary bonded company, you might want to reduce those before year end. You want to aggressively try to collect your receivables. You want to minimize your underbillings. You want to maybe defer equipment purchases until after the first of the year. Now, realizing that all of these strategies will have consequences, tax consequences and other, you want to do these things in conjunction with your CPA before you actually pull the trigger on those. But those are some of the things that you can do right now to help you getting into 2023.
Awesome, Kevin. Some great insights on there. And one of the most important things is also communicate with your bonding agent. Make sure Kevin knows your plans going into 2023 and what it's looking like, so we can make sure that we can advise you to where you want to be, because it's always good for us as service providers to know where you're going, so we can say, hey, you need more working capital. Because I know, Kevin, when you get those, when it's 12/31, it's kind of hard to do those adjustments, right? After the fact.
It's pretty difficult, yeah.
Yeah. So Kevin, the past 2 years, we have this big thing going around called COVID. And I know it's affected a lot of industries, and bonding probably is no different, just because of the variability that can be seen in the balance sheet, and also some of the government programs and how they've been presented on the income statement and also affected the balance sheet. Can you tell us about the underwriting process of how companies and the people that you represent on the surety side are handling COVID and all the items that have happened throughout COVID?
Sure. I would say that the primary focus for bonding companies has been on the contracts that their customers are signing. When COVID first presented itself in March of 2020, really there wasn't a lot known, and a lot of things happened that some of the states shut down construction, some of them did not. So it's been it's been kind of a wild card, but primarily the contracts that you sign are being looked at more closely by the surety, and the surety wants to see that your contracts minimize the risk that you have for shutdowns that are due to COVID. They want you to negotiate contracts that have time extensions in case there are supply chain disruptions. They want contracts that allow you to have the flexibility to substitute materials of equal quality for those that are maybe difficult to obtain at the moment. And contractors, we're seeing a lot of contractors buying materials for a project up front because of the lead time, especially in areas where roofing, concrete, precast concrete and things like that, where the supply chain has really become very slow. So any chance you get to buy materials up front, but also to be paid for them contractually by the owner as stored materials is a good thing for you. So I would say the sureties are focused more on contracts and making sure that their bonded customers are not assuming all the risk for COVID and supply chain disruptions and things like that. I would say that would probably be the number one thing that we've seen the last couple of years.
But the time frame to get that bid bond or performance bond is still pretty attainable for those ones that give you the day before, correct?
Oh yes, the market has really been very good, and the bonding companies are still very flexible, very open, and they will stretch with their good customers. If you're a profitable contractor that has demonstrated the ability to be profitable and maintain a strong balance sheet, bonding companies have been very helpful to those types of customers. But they've also been a little more wary of the customer that has trouble making money, realizing that the last couple of years have been tough, just regardless because of the COVID situation. But if you couldn't make money before COVID, it's not likely you're going to make money after COVID. So yeah, I mean, it's really one of those things that there really hasn't been a major change in the marketplace, just a little more focus and scrutiny on contracts and making sure that contractors are well financed.
Awesome. Thanks, Kevin. So let's go back to what you said originally before about this working capital, okay? And maximizing working capital. Why is that important, maximizing working capital?
Well, sureties have been able to determine over the years, when they go back and look at their losses, that contractors, as they say, never run out of work, they just run out of cash. Liquidity and having adequate amounts of cash and access to cash are probably the most important factors in keeping contractors from running into major problems. So that is why your surety is going to preach working capital. And not only are they preaching that you have working capital and an adequate amount of it, but that it's also composed of the right things. If 90% of your working capital is tied up in a large underbilling on a project that's losing profit as time goes by, that item is going to be scrutinized not favorably. So not only do you want to have working capital, but the quality of that working capital and the more liquid you are is extremely important to the surety.
Awesome. Thanks, Kevin. When we talk about we've talked a lot about the surety market and how you said that the sureties are pretty flexible currently with their good customers, and also with the customers that maybe have some challenges, there's also room for them. And I would happen to say that probably relates to what the current surety market outlook it looks currently. So can you talk a little bit about that market, of what you've seen out there currently?
Yes. I think we have a slide for that was up before. I like to show this slide because it shows that there's definitely a relationship between construction spending in the United States and surety losses, with a couple of blips that are a little unexplainable. The yellow line here is the surety spending in billions over the last 20 years. And the blue line is the surety loss ratios over the last 20 years. And in general, you can see that when construction spending decreases, surety losses begin to increase. And the inverse is true in most cases. When construction spending starts to increase, surety losses typically drop. There are a couple spots in this graph where that maybe doesn't hold true. And especially when you look at 2020 to 2021, you can see that surety losses dropped significantly, or had gone up from 18 to 20, but then dropped significantly in 21. This worries me a little bit because you could see that spending was increasing, but losses were increasing as well. But all of a sudden we have this decrease. Well, I tend to think that decrease is from all that PPP money that the contractors got in 2021, which at least temporarily bolstered the balance sheets of many contractors, allowing them to at least survive through COVID. And one has to wonder if that curve is going to start going back up now that the PPP money has already been spent, and we're getting back to more of a normal situation. But the market still remains strong. There are a number of players out there. We've seen over the past 20 years a lot of consolidation in the market with acquisitions, a lot of companies acquiring other companies. The top 15 surety writers in the market today, there are eight companies now in the top 15 that weren't in the top 15 20 years ago. So a lot of changes in the marketplace, but these players, the surety being a very profitable product, the management of insurance companies say, let's go out and get more of that stuff. Yeah. That creates a lot of competition in the marketplace. Rates get driven down, companies become loose, and it's very cyclical like any business. We'll suffer those losses, and we think they're coming in the next 5 years. We're just not sure exactly when.
No, great. That chart is pretty interesting. It'll be interesting to see, like you said, the prediction that it could be in 2022 when we see that data on there, in 2023. Because when you make money, like you said, you loosen up a little bit, and that's how you make money. But then some of the stuff happens to make you tighten back up. So I think you've seen it through your 36 years. The ups and downs of the surety market. So thanks for your insight, Kevin. Again, if there's any questions for Kevin directly, please put them in your chat. We'll probably follow up as needed at the back end of this if there are questions. So feel free to post those, and we will follow up with Kevin on here. So now that we have a good understanding of the bonding market and working with your surety, let's talk about the legal side of things. And Phil, from a legal perspective, what should contractors begin doing to better prepare for the coming year?
Honestly, pick one thing and commit to doing it really well. We're gonna cover a lot of really good things this morning, and Kevin's already got us off to a great start. But there's an awful lot of things to evaluate, consider, teach, review, implement between the time that the asphalt plant's shut down or work outside slows down and work kicks back up again in the spring. But along with finishing this year's jobs, getting the work done that you can during the winter, and making sure that your backlog is full for 2023, trying to do all the things that we're going to hit on here is going to feel overwhelming or feel like a waste of time, and you're end up not going to do it. So really committing to one thing, I would say, should be a goal coming out of this today. I'm obviously going to talk about the legal issues, but to kind of help our panelists specifically, find one thing that really resonates with you and commit would be right out of the gate my first advice.
So Phil, when you're looking at that one thing, and if you're dealing with construction companies all the time and seeing where some of the issues are in regards to contractors being ready or contractors being as flexible and be able to shift as much as they can, where would you start with that one thing that is probably consistent with a lot of companies you work with?
Well, the softball for the lawyer is contracting. And to evaluate your contracting practices, not just to have good forms, but to really evaluate your contracting practices. And obviously you have to consider what type of a company you are. If you're a GC or a CM or a design builder or a specialty prime, you're using proposals. Do you have contract forms that are coming from the owner, from the architect, from an owner's representative, or are you just using theirs? And are you negotiating those contract terms? Obviously, if you're focused on public construction, you're really limited as far as what say you have and what terms and conditions are going to control. But if you're not, if you're in the private construction world, how much effort are you engaging into negotiating terms? If you're hiring subs, are you negotiating sub scopes and prices? Are you using a subcontract of your own? Are you using the bid proposals that come in from subs and suppliers? And if you're suppliers, are you just using the subcontractors form? Are you using a purchase order that's used? Are you doing anything? Are you utilizing any of these different mechanisms for your own purposes? And if you're not, then obviously it's time to start thinking about having a process that you go through when you're getting hired by a customer or when you're hiring a vendor or a subcontractor. Everybody gets hired and everybody needs labor and material on construction projects. There's contracting opportunities that happen all the time. And the reality is whether you succeed or fail on any given construction project is going to depend on how strong not only the forms are, but your processes that you use. You know, the one thing that I want to get out here for all of our attendees is you don't have to accept your customers or your vendors form. There's a huge presumption, particularly in the smaller company world, that we just have to take the contract we get or the subcontract that we get or the purchase order that we get. And that's not true. You don't have to eat all the risk that's associated with increased material cost or the delays that are incurred from supply chain issues or labor market impacts. You don't have to. You have every power, every right to negotiate those terms, even just a little bit, that are better for your situation versus just simply taking a form that somebody gives you and go along with it. For subs and suppliers, pay if paid does not have to be absolute. A lot of us understand that conditional payment clauses for our payment contracts are a reality, but they don't have to be absolute. There's things that you can do to mitigate that payment risk. Signing and accepting a contract, Dennis, it's actually called negotiating. In law school, when you're actually signing a check, it's negotiating a check. When you're signing a contract, it's negotiating a contract. Wouldn't it be nice if we actually negotiated the terms and conditions of these contracts that we're negotiating anyway? So having a process, having a procedure, having an understanding with your team, with your project managers, with your with your accounting department, with whoever it is that's in your organization, having a clear understanding and taking that time to sit down and say, all right, for these different buckets, here are the types of contracts that we see or that we're going to use, and here's what we want to do with each one of them. That's a great place to start.
Yeah, and like you said, Phil, there's so many, people think of just the main contract that you have with either the owner or a GC if you're a sub on there, but there's so many other contracts that you enter into throughout your practice in the construction world. Kind of relating a little bit back to what Kevin said on here, and the changing market and the change in adoption of certain language within agreements due to COVID on here. I mean, how often, if you haven't reviewed your contracts since before COVID to now, I mean, what's the standard practice you tell your clients, and what have you seen on that side about the timeliness of reviewing these, and what should be a good point for each client of yours to really review their contracts?
Well, that's the funny thing, is that if a lot of the contractors who didn't go through a review process or take stock of their processes and procedures with contracting in 2022, they were left holding the bag, because a lot of the agreements that were prepared in 2019, as late as 2019 or even 2020, didn't account for a lot of the things that we ran into arising out of COVID, whether they were supply chain issues, whether it's delays or costs, right? Because we had impacts from the completely volatile pricing market for materials. Every material incurred pricing issues, but then delays as well. You had boats that were stuck out in the harbor out and on the West Coast or the East Coast for days and weeks at a time. That impacted the timeliness of materials getting delivered. And if your contract provision didn't allocate that risk or help spread that risk as the subcontractor, as the supplier, or even as the general contractor who really is in charge of making sure that this building gets built or this road gets put in according to the owner's requirements, you really didn't have a whole lot that you could work with other than making claims and trying to be creative with the contractual language that existed at the time. If you had some foresight to actually get into your contract documents in early 2021, mid 2021, at any time, you were able to put yourself in a little bit better situation to be able to negotiate. And of course, there's a whole lot of different procedures and tactics that you can use to try to spread that risk. Are you going to be able to shift all of the risk for supply chain delays or material costs on your customer? No, probably not. But there are ways that you can spread that risk and take on some of it while also sharing some of that risk with your customer. So yeah, I mean, the timeliness of a review, paying attention to the world around you and saying, geez, this doesn't sound good. Maybe we should dig into our contracts a little bit more. That's really taken that eyes wide open view and really looking around and understanding the total landscape and having that view and incorporating your risk management, your contracts as part of how you're managing your company.
When you see that, Phil, when you work with your clients, that when the Truax Law Group works with its clients, are you surprised sometimes on the lack of the last time they were reviewed on there?
Not anymore. Yeah, I mean, it's real common. Running a construction companies, it's busy. There's a lot going on. There's a lot of different things that are happening, and just to continue to keep cash flow going and keeping the backlog full and making sure you're getting work and bidding work at a profitable level and managing all of the internal issues with employees and supervisors and making sure that your projects are being run appropriately. I mean, you could go on and on of all the things that get involved with running a construction company. And the sad reality is that contracts often take a back seat. Contract procedures, even worse, in taking a back seat. What's lumped in with contract procedures is the documents that go along with contracts, whether they're lien waivers or whether they're pre-lien notices with notices of commencement and notices of furnishing, tracking last days of work and lien rights and all that other stuff. oftentimes those things take a backseat to what construction company owners run into. So unfortunately, I'm not surprised with a lot of the times that we see that. Now, there are times where we're representing larger companies where you think to yourself, man, you got too big of an operation to have these kinds of issues from your contracts. I still run into contractors who haven't adjusted their insurance provisions after, we can get really into the weeds here on lawyer talk, but there were two Ohio Supreme Court cases over the last 2 decades, decade and a half, that really limited the ability of construction insurance or confirmed the limitation of construction insurance to cover certain types of property damage, not being able to cover defective work or property damage directly resulting from defective work. There are 2 big cases that came down. Every construction lawyer saw them. Everybody who's on LinkedIn and who follows either any construction law firm or insurance practice, they all saw this. And yet substantial contractors, substantial construction companies have not made changes to their subcontract agreements, for example, on making sure that the insurance that they're requiring their subcontractor to buy for the project account for that limitation that, by the way, is unique to Ohio and 2 other states as far as that limitation on construction insurance. But the point is, there's been a lot of changes in the law and a lot of changes in things that have happened over the last few years that a lot of contractors have not kept up on. So that part of it I am surprised about.
So when we're really talking about the contract review and the contract law and what you're talking about is shifting risk and mitigating risk as much as possible. So trying to control the risk that our contractor clients are taking on. Which risks are shifting to their customers or vendors? Like how do we know what we can shift over to them in an agreeable way? Like what are the key points that we should be looking at that will allow us to shift some of those risks?
Well, I mean, there's obviously payment issues. We talked about that earlier. There's conditional payment clauses and trying to find ways to limit the impact of those conditional payment clauses if you are a downstream contractor, and understanding that from the upstream, understanding that if you're a general contractor or a construction manager, that a sophisticated subcontractor is going to want to try to limit the impact of a pay if paid clause. And they want to find ways within the contract, knowing how construction projects work, knowing all the different players that are involved, how delays or cost issues can come up and are going to impact the owner payment faucet, and who's responsible for handling that risk of not being paid for work that's performed. And then what happens after that? You know, it's to not be paid timely for work performed. That's a big problem. But then thinking about how it then impacts you as a contractor or a first tier subcontractor, for example. A lot of times you have a pay if paid clause or even a paid when paid clause, but you also have an obligation to indemnify the owner or your customer for any other liens that are filed on the project. Well, a lot of times it's hard to keep the project free of liens if there's $250,000 of billings that are out there on a project, and that $250,000 payment is lawfully withheld because there's a conditional payment clause, but then you've got $200,000 worth of bills downstream that you've got to pay, and if you don't, they're going to file a mechanics lien. And are you then obligated to make sure that the project is kept free of mechanics liens at that point? If the contract says you do, then you might have to. And so understanding really the practical impacts of how that all works and how you're able to manage your risk, that's an important part. You know, we talked about insurance. What insurance are you required to carry? At what limits? What insurance is your vendor or your supplier or your subcontractor required to carry? What's primary coverage for a given property damage or a personal injury claim? Making sure that, you know, you're understanding all of those issues, claims, you know, extras. There's every project has change. Every project, everyone who's involved in construction projects and progress with construction is going to see change. So how are those change provisions managed in the contract documents? Who's responsible? What are the notice provisions? Are they reasonable? We see 24, 48-hour notice provisions. Just because people respond via text message and email and can respond instantly with written communication does not mean that anybody on this call should ever sign a contract that says you're obligated to give notice within 24 hours of something happening on a construction project. And there's probably some of you that are laughing and saying, yeah, I would never do that. I've seen it with big contractors that just want to get the project signed. They got to get moving and they gloss over that issue. Well, I don't have to tell you, and I know we've got some people on the call here who are very well aware of this. The Ohio Supreme Court is pretty darn clear that if you don't give timely notice of a claim, no matter how big it is, and no matter how well known it is throughout the entire project, that claim is as good as dead. So making sure that the contract has reasonable time periods that you're required to put your customer on notice to say, hey, we ran into this rock that's underground that we didn't anticipate, that we're not in the drawings, and we need to get a change order. We need to get you out here and look at this condition that we didn't foresee, that nobody knew about. And it's going to cost us 200 grand to get through this and work around this and put this project in like you wanted us to do it. But the conditions don't match what the drawings say. If you don't put that in writing timely under the contract, then you're going to have a big problem. So there's a number of those types of issues where, and by the way, once you get those changes in the contract, say you are diligent in how you're negotiating your contract, how you're reviewing the agreement, and you're making changes, then you've got to implement the systems with your project team to make sure that you follow it. I mean, it's great that you're going to extend the notice provision of claims in a contract from 48 hours to 10 days. But if your project manager doesn't know that now we have 10 days to make a claim for any changes on the project, what good is it? So you've got to make sure that your contract is communicated, is read, first of all, and then is communicated appropriately to your team. A great mechanism is to do a simple contract summary. Just have a simple one-page document that bullet points the key provisions that are in that contract that you want your project manager, your superintendent, whoever's in charge of documenting the project, maintaining daily reports, maintaining daily logs, completing change requests, issuing notices to other folks on the project. Whoever is responsible for that, making sure that they know they've got a thumbnail sketch of what our contract requires. It doesn't take more than an hour to do something like that. And to do something like that is incredibly valuable and a very good way to make sure that you're managing that risk on the project as much as you can.
Thanks, Phil. You know, I think the past 2 years, there was the terms within contracts that maybe confused some people due to COVID. It was the force majeure wording in contract. Can you kind of talk through that and why, like, a lot of COVID type reasoning did not fall into that clause within the contracts?
Yeah, I mean, I think, you know, for the longest time, a force majeure clause really talked generally about things that are outside of the party's control, but that's really vague, right? What's outside of your control? Well, there's technically a lot of things that are outside of your control, but as the contractor, as the first-tier subcontractor, you're expected to have control. You're hired to have control over the scope of work. And unless you define what that control is and isn't, then there's going to be a big problem over the arguments over what you had control over and what you didn't have control over. So when you have these old school force majeure clauses that don't have a lot of detail, that talk about things outside of your control, that talk about acts of God or extreme weather conditions or whatever it is, and then has that catch-all or other events that are outside the reasonable control of the contractor. Well, what does that mean? And does that mean a global pandemic that effectively shuts down the economy and slows the manufacture and distribution and supply of goods, such that now we're going to have to wait 8 more weeks to get our metal studs? I don't know. It would be a hell of a lot better, though, if we actually had that in the contract that said that there were, even generalizations to, government orders. Government orders would have helped. That's not necessarily a foregone conclusion that those are in force majeure clauses, but obviously we know that on, I think it was March 17th, 2020. Don't ask me why I remember that specific date, that we got the stay-at-home order from the state of Ohio, but we did. We got a stay-at-home order from the state of Ohio that told everybody you can't leave. Now, of course, there were the provisions in that stay-at-home order that accepted construction to allow construction to proceed, but that didn't necessarily help the suppliers who are making the widgets or the screws or the bolts or the other small components that go into the materials that are needed for the construction project. So then that supply chain slows down incredibly. The point is, Dennis, it's really one of the things that I wanted to talk about, and I know that we've got to move on here, is one thing that's really great to do at a time like now. This applies to every business, even our professionals who are on this call, attorneys, accountants, insurance folks, whoever it is, and your own business, is taking stock of what happened in 2022. Doing a post-mortem on the projects and the things that went really well, or a post-mortem on the things and projects that failed and why, and sitting down with your team and understanding, why did this happen? Not to blame anybody, just to understand what are the components that went into it and how things crumbled right before our eyes, or why we killed it on this job, and what are the things that we did right, whether it's contractually or practically or from a management standpoint, and then taking those nuggets and applying them for 2023. That's a great thing to do from a legal perspective and understanding from a contract side what to do, but generally speaking, running your business and utilizing that great data that we just had in 2022, which had a mishmash, by the way, of still COVID-related impacts that were still lingering from the first half of 2022 to what might be considered more of a typical environment. There was a lot of sample tests in 2022 that we can all look back on and apply going forward for 2023, legally or otherwise.
Thanks, Phil. I think, yeah, the post-mortem sounds like a great idea to kind of get your mind right for this coming year, to see what you should be concentrating on and what you need to work on. Always a good point to do that with whether in your own business or whether you're working for someone else. Thanks, Phil. We're going to jump over to Whitney and Joe. There's been a lot of talk surrounding tax incentives that construction companies might be able to take advantage of, going back to the Trump tax reform, to the CARES Act, to the Inflation Reduction Act. And we're going to talk specifically about those incentives that can help construction companies. So what type of tax incentives should construction companies be looking at, Joe?
One specifically. So first of all, thanks, Kevin, and thanks, Phil, for your expertise. And we are really excited to share with you guys about what's been going on in one area of the tax code, Section 179 capital D. And here's the backstory a little bit. We've done about 60,000 studies. We've delivered about $3.2 billion to U.S. business owners. And historically, about 65% of 179D incentives go unclaimed. So that means that a lot of companies, taxpayers that are eligible, don't claim what they're entitled to for one reason or another. And I would encourage every business owner that's in the construction industry to look long and hard at Section 179D. It's the energy efficient commercial buildings deduction, and it's been expanded and made permanent here recently under the COVID relief bill and the Inflation Reduction Act. The maximum available deduction for current projects is $1.80 per square foot. That's before any inflation adjustment. So if you have a 100,000 square foot project, taxpayer could be entitled to up to $180,000. Beginning in 2023, the maximum 179D incentive goes all the way up to $5 per square foot. So just in terms of the dollars available and the amount that's gone unclaimed historically, we're seeing a huge opportunity that many business owners either, for lack of awareness or maybe their projects don't align, or for whatever reason, haven't claimed what they're entitled to.
Awesome. Thanks, Joe. So this 179D deduction, can you describe a little bit more? How does one person apply for this deduction? How does someone become eligible for this deduction? And just how does it work?
Yeah, it really breaks down two ways. So look at everything from the perspective of the project. If a project's owned by a private taxpayer, right? Say, for example, the building I'm in right now, we own it. We claim the 179D on it, worked out real nicely. And we're a private business. If the building is owned and the project is owned by a non-tax-paying government entity, like say, for example, a school district, military installation, a Department of Veterans Affairs hospital, a U.S. postal system, a processing and distribution center, right? A public higher educational university. Any of those owners don't pay federal income tax. So Congress was looking for a way to bring dollars back to the companies that are working on their projects. And so those owners, when it's a public or government-owned building, they're allowed to allocate, and they're encouraged by the government, federal government, as well as two state governments, including Ohio. They're encouraged to allocate the 179D deduction to somebody that worked on the specifications for their project.
Awesome, Joe. So allocating is of being able to allocate this deduction to a contractor. How much dollars are we talking about in allocations, and what are the aspects of making sure that you get the allocation?
So really good questions here. So number one, the dollars available, it's not as though there's a bucket of funds in Washington, D.C., or a fund that's available. The extent to which a taxpayer can generate an economic benefit is only limited to the amount of taxable income that they have and the type of projects they're completing. So really, it's, the sky's the limit. We have clients that claim 10 million in deductions annually. We have clients that claim 50,000 in deductions annually. And it's all based on each taxpayer's unique facts and circumstances. In terms of dollars available, I'd say each business owner should be looking at it, and we can look at it those two ways, through their projects and then through their tax situation. The allocation process, it's best done as quickly as possible. It's best done as soon as possible. Historically, what's happened is these government owners, school districts and otherwise, they've more or less allocated on the first eligible party that's made the request. So if you have an architect, an engineer, and a contractor, and maybe one or two subcontractors, all who are qualified to receive the allocation, that owner is historically going to just allocate to the first eligible party that makes the request. So our recommendation is to look at it as early as possible with regard to any of your projects. And we have a database of roughly 250,000 government-owned projects where we've kept track of this for the last 15 years. And that is the best way for us to evaluate whether something's available.
All right, Joe. So I'm a downstream contractor. I'm an HVAC contractor, a lighting contractor, roofing. I do glazing on there. So I get $1.80 per square foot on there. But again, I'm just doing one aspect of it. How does that work out?
Well, not necessarily. So it's all going to be dependent. It'll be dependent on what the allocation letter says and what the energy analysis results in. So first of all, you'll have the allocation that's granted by the owner, and it can be to one party, it can be to one project participant, or it can be split up amongst many. And say for example, if you have a mechanical subcontractor that was involved in the technical specifications, if they receive 100% allocation of a particular project, and the mechanical systems, the HVAC systems, achieve the right amount of 50% energy cost reduction when analyzed, then that taxpayer is going to be eligible for the federal maximum deduction, which currently is that $1.80 per square foot and going up to $5 per square foot. Now, there is a limitation. So the tax code does preclude anyone that merely installs or repairs. So you would have to have some involvement in technical specifications, but that's where our teams of project managers and engineers will work with our clients to identify whether or not they're in fact eligible.
All right, Joe, you said, I think before 65% of these deductions go unclaimed, right?
That's right. Yeah, 65% historically.
Why do these deductions go unclaimed, Joe?
So we looked into this. It's really interesting. So number one, a lot of C Corp companies that are set up as C corporations have managed their income in other ways and don't see it as something that they need to claim in order to optimize their tax position. So that's one reason. Companies that are set up as an S Corp ESOP have no need or desire for a federal tax deduction, right? And then other companies, say architecture firms and engineers, sometimes will only claim, say, 1 or 2 out of 5 or 6 projects that they're eligible to claim in any given year. And that can be for a variety of reasons. Maybe they're limited in the amount that they can actually claim. Maybe they don't wish to put the request in front of the owner that they've worked with, like a school district. There's a whole bunch of reasons, but the bottom line is that more is going unclaimed than is being claimed, and the dollars are still available.
Joe, I thought you were going to say the bureaucracy and the red tape of dealing with the government is why the majority of them don't come unclaimed. But how can you talk through? Because when I always talk with my clients about this process, and you get into, well, we got to get the allocation letter, and we got to do the study, and they're like, whoa, that's has the W word in front of it, work, and I got enough work. Can you talk about kind of like how Alliant Group helps? Basically be the back office to get this deduction allocated to our customers and the people on this call.
For sure. So Phil made a great point. Owners of construction companies and contractors have busy lives. It's true. We work with so many companies where the owners tell us that they don't have time to take on an extra project like this. So we've refined how we conduct our study process over the last 15 years. And we'll do everything turnkey for our clients. Starts in phase 1. We'll review which projects they've done with the right type of owners, meaning, say, school districts and government agencies. And for those projects that are available, meaning not yet allocated, not yet claimed, for those owners, we'll actually start pursuing those allocation letters on behalf of our clients so that they don't have to go and explain 179D to the school district or to the military or follow the Corps of Engineers process for approval. There's so many pitfalls and ways that time can get wasted. So we've actually been through this. We've been through it with more than 8,000 different unique government owners. We've worked with those owners, and we've sent our engineers out to do these studies. So we'll do everything turnkey for our clients, and only the projects where we get the approval from the owners to proceed with the study will we actually run that engineering analysis. And then at the end of phase 2, we'll know, does the project qualify? Did it hit the energy cost savings requirements in the tax code? And is it one of those projects that Congress was intending to reward with that federal maximum $1.80 per square foot? Again, under the Inflation Reduction Act, now the max is moving up to $5 a square foot. So what we're anticipating, we don't know yet because this is effective for January 1st, 23 and later. What we're anticipating is that there'll be a greater number of projects going unclaimed now because the maximum is higher, and thereby companies will get their fill sooner. So despite the fact that 179D is now permanent, so Congress made it permanent last year under the COVID relief bill, and then expanded it last month under the Inflation Reduction Act, we're still anticipating that there's going to be more allocations available than previously. And that's just because the maximum dollars available are higher, and taxpayers are likely going to get filled up sooner.
Thanks, Joe. Can you, one last question that I have is, you know, when you're going through this planning and when you're looking at it, a lot of people will be like, well, I just found out about it on this webinar today on October 4th. Yep. But I had these public jobs that I completed 2 years ago. What do I do now? Did I lose it? Can you talk a little bit about that, Joe?
For sure. So each project, when there's a government owner, when a taxpayer, like a construction company or an architect or an engineer, receives the allocation, that project's 179D deduction is applicable in the tax year that corresponds with construction completion. And the taxpayer has 3 years from the original date of filing to either amend or claim that 179D deduction in that particular tax year. So our current work with our clients is actually going from the time frame January 1st, 2019, all the way through projects that are currently under contract and under construction. So there are projects that say were designed, put under contract in 2017, which feels like a lifetime ago. Construction was completed in 2019. And that taxpayer would be able to claim a 179D deduction for that particular project on an amended tax return sometime, say in the fourth quarter of 22, first quarter of 23, and maybe even longer if they had originally extended that 2019 tax return. So there is a pretty wide window, and the message from Congress is pretty loud and clear. They want business owners to take advantage of the 179D deduction. They want more companies to claim what they're entitled to, and we'd be thrilled to help.
Awesome, Joe. And Whitney on here. I mean, this is one that I talk to a lot of my clients about, the 179D, especially ones doing the public work, that it's, you know, if they're not aware of it, it's always good to have that free look at to say, well, what does it look like on my jobs? Because we all do our WIP schedules. So you have your jobs there, and a quick analysis just to see what's out there. Taking out all the red tape and everything else is great, because they can stick to what they're good at, and you can stick to what you're good at on there. So thanks, Joe and Whitney, for being a presenter today and talking through.
Thanks for having us.
Deduction on there. So what I wanted to just touch base on just for a couple minutes is just on the accounting side. And I'm just going to talk through a couple of things that I see out there with Q4 here and going into 2023. And a lot of it's already been touched on through Phil and through Kevin, and also through Joe's webinar, but it'll be kind of good of reining everything back in. So my thing is that, you know, when you look at this, the unsettling news that we're always in with the economy and the Inflation Reduction Action, inflation in general, the midterm elections coming up. So there's a lot of variables that are up in the air for us and your industry. And a couple of things that I'm concerned about going into the end of the year for my clients and going into 2023 are in job costing. All right, so underbillings. I think Kevin and I will be scrutinizing underbillings even more this year, and that means cost in excess. All right, so where are we at on our jobs? Because of the inflation of where we're currently at around mid-8s, I worry on some of my underbillings on my clients. And did we take into account of increasing the denominator in our cost to cost equation to take into account those additional costs that we're having from inflation that we weren't able to pass through to the customer? So am I hiding an underbilling on my job? So if you're a client of Corrigan and Krause and you have a large underbilling on your WIP schedule, we are going to be sitting down and discussing it to make sure that, especially going into 2023, where we see the unknown and everybody's talking about recession and a pullback in the economy of 2023, I don't want to have Kevin getting a large underbilling that turns into profit fade in 2023. Kevin doesn't like that, and Kevin Sureties that he represents does not like that. So we're going to be scrutinizing underbillings like you should be. If we're underbilled on a job, we have to figure out, does that turn into a receivable? Does that turn into a receivable? And if it doesn't, let's be truthful of where we're at, because we don't want to set us up for failure in 2023 by taking a big profit fee. Job borrowing on a job. If we've been able to bill ahead for some reason, all right, if we have billings in excess on there, I want to make sure cash in the bank account equals my billings in excess. Or if I have a net overbilled, if I'm net overbilled, I want to make sure I have enough cash in there. If I'm overbilled $1 million and there's zero cash in your bank account, I don't think Kevin, I'm calling on Kevin a lot on here. I don't think Kevin and his surety companies are going to be like, all right, well, where did this cash go? You're overbilled $1 million and there's no cash on the job. Well, hopefully those are in receivables and not aged receivables either. So look at your billings in excess, your overbillings on there. And lastly, backlog. I'm very interested to see where all of our clients' backlog is at the end of this year. All right. Not only backlog, but backlog GP on these jobs on there to see what we have going into 2023. I know a lot of my clients, and I would assume the same thing with everybody on here, had awesome backlogs. We're basically sold out in like Q1, Q2 of this year for the whole year on there. So it'll be interesting to see where those end up, not only at the end of this year, but also going into Q1 and Q2 next year, where I think that we'll see a large decrease in our backlogs on there, just because of the unknown that we see currently. Kevin also talked about balance sheet management, and I'm a big proponent of balance sheet management. There's a lot of things that you can do, but when I look at balance sheets, I look at the two things, the two L's of a balance sheet: liquidity and leverage. And making sure liquidity is the working capital piece that Kevin talked about, making sure that you understand how your surety looks at those items. All right. And Kevin told you about some of the add backs, because people will go, whoa, look at my current assets minus my current liabilities. I have working capital. Let me take 7 times that. This is what I should get. But if it's all made up of old AR, if it's all made up of shareholder receivables, if it's inventory, like Kevin said, and there's things that are going to be reduced just because that's the way it is. I like what Kevin said about the prepays, is that maybe you don't want to prepay stuff. Keep it in cash and you'll get more there, and that'll be helpful for those types of things, especially if you're prepaying insurance and doing other things. You got to plan for when it's tight, so you have the ability, and Kevin can go to work for you to try to get you the bonding that you need. The last thing would be on the balance sheet management is the cost of capital. You got to really look at the cost of capital, especially with these rates going up. People bought a ton of inventory and wanted a bunch of inventory during COVID because they didn't know if the supply chain they were going to get it. Well, now the inventory's kind of slow moving and interest rates are going up. So guess what's also going up? The borrowing rate on your debt is going up. So our idea is that we really got to look at a way to shrink our inventory levels down to convert that into cash now and reduce the amount that is on our line of credit on there. Because Kevin, in the bonding world, we like a backstop. And if your backstop of your line of credit on a 2 million line, you're at 1.5, it doesn't give us a lot of backstop. So let's start bringing down that inventory level to a realizable level, knowing that you also bought it at a time when that inventory is worth more now due to inflation. So you're not going to really take a haircut on it if we try to get rid of some of it. All right. The last thing is tax management. This brings in the Joe's area is tax legislation. We don't know what's going to happen in November, so it's going to be hard to plan for the midterms. But we do know what the Inflation Reduction Act brought. All right. And we know that there's incentives out there in what Joe can do on the 179D to help mitigate any future tax changes of going back and getting old money to hopefully mitigate the future money that you may have to pay out. We don't know where the elections are going to go in the midterm. We know that if they do go and stay where they're currently at, we may be seeing more tax legislation happen in 2023. So we have to be prepared for that. So I talk with a lot of my clients. They're like, well, let's get planning in October. And I was like, well, if we plan in October, we're going to have 2 sets of plans. All right. Because one with the plan that taxes may change, and one with the plan that taxes aren't going to change. Because we don't want to go and make 2022 not pay any tax and push it all to 2023 when I have a variable there. So tax legislation is going to be a big thing out there. Tax mitigation, 179D, research and development credits, which Joe didn't talk about, but which are prevalent and are money out there where I assume Joe will tell you again that 65% probably go unclaimed on there. I think it's probably around, it's probably a number like that. So there's tax mitigation techniques that you can use to mitigate and save your working capital on there. And the last thing is employee retention tax credits. All right. You hear all this, people don't think they qualify. If you are not asking your CPA due to the change in legislation that happened with allowing both employee retention tax credits and PPP, and also allowing for supply disruption type eligibility instead of just straight revenue based, talk to your CPA. If your CPA hasn't talked to you, talk to us, talk to Joe on here. There's money out there for employee retention tax credit. The only issue is that you're going to be waiting 6 to 8 months to get that money from the government. And some have been even longer on there, because I'm sure that you've read some of the horror stories out there that people have been waiting for a year for this money on there. So when we take this down to things that you need to take from this on here, and I wrote down a little bit from each person on here, and then maybe I'll go to a couple questions more that I can see came in for some of our panelists. Is the communicate. All right, communicate. Kevin's first thing is communicate. All right, set up that meeting, make sure that the CPA understands, make sure your surety is on the same page of how this year's end of the year is going to look like. If you don't communicate, then, and you provide a financial that's different from what the expectation was, it's hard to help when you don't know what's out there. So communicate is what I got from Kevin. From Phil's, postmortem. Make sure you're doing a postmortem on what you did in the past, what worked, what didn't work, and bring in your experts or leverage the knowledge that you have with Phil in the legal area, Kevin with the surety area, and Joe with the 179D to say, this is what we did last year. This didn't work. How can we help mitigate this? You know, sharing of problems is a problem solved, as my father-in-law used to always say, is that if you keep them with yourself, you're never going to figure it out yourself because you don't have all the answers. Google has all the answers. No, Phil Truax has all the answers on there. And then the other thing is just be aware of items that are out there. People hear 179 and they probably automatically think, well, that's depreciation. I'm already taking that. I'm already taking depreciation on there, but this is 179 Cap D. Cap D. So make sure you're aware of it. It is very, very lucrative for your contractors, especially ones that are doing public work. It can set you apart from a lot of your competitors. You can't do it in the state of Ohio and I believe North Carolina, but Joe and I have recently been seeing a lot of people are saying, hey, these jobs are eligible for 179D. Do you think you can give me a price cut on the contract if I get you an allocation letter? Illegal in the state of Ohio, right, Joe?
That's right. That's right.
In North Carolina?
Florida.
Florida. You can't
Florida
do that
Ohio.
in Ohio and Florida. In the other states, you can do it, but again, there's so much variability. You have to get with your experts to talk about that, because there's the cost of doing the study, the cost of what if you're at a loss position, you don't get the deduction. Now you just paid for something that you don't even get on there. So you got to talk through and work through those types of things. So I enjoyed everything with the panel on here. I'm going to ask one question to each person to kind of sum this up, and then we'll wrap up and get us out of here. Sorry, we may be a little bit over, but there's a couple of questions that I think will be helpful to everybody on this to kind of answer, and then we'll wrap up. All right. So, Joe, why would I use an outside consultant to get the 179D incentive? Why can't I just call up Phil, Kevin, or Dennis to get this? Why would I use someone like Alliant Group?
Really simple. You need to have an expert that has two things in place. Number one, the ability to secure the allocation letters from the government owners. And number two, that has licensed engineers to analyze the projects. You have to have both. Without those two items, there's zero value in the 179D deduction, and we have the team to do it.
I also think that if it's going up to $5 a square foot, there's going to be a lot more scrutiny in revolving around these deductions.
There will be. We're expecting it. That's why we build every single study as though it was going to get looked at, and we use insight from the 4 former IRS commissioners that are on our staff.
Awesome. Thanks, Joe.
You bet.
Phil, I know that you personally don't focus on in labor and employment law, but you do have a bunch of people at your firm that can help out in those areas. What can the clients, our clients and the clients on here do from a labor and employment standpoint to protect themselves? Rookie mistake.
Sorry about that. Another easy lawyer answer is the handbook. Making sure that your employee handbook is detailed, is up to date, has been looked at for the last 10 years. Those are all good things. There's a number of issues that have been popped up recently that make a good handbook review. Also worth considering whether your officers and key supervisory personnel have employment agreements. Not employment agreements aren't necessarily appropriate for everybody, but particularly if your officers and your supervisors are really deep into your estimating, your financial information, your proprietary methods, doing what would be a good idea to protect against. Everybody leaves these days. There's not many people that stay at the same employer for very long. So recognizing that as loyal of a relationship as that may be, that person may go, and if they do, what does that look like? So taking the moment to really think about that. And then, another thing we've seen a lot about is things like travel pay and per diem, and questions about how that's handled, how in what circumstances is travel pay required, and in which circumstances is it not. Jobs that are hour and a half away, employees driving back and forth on a daily basis versus people staying in hotels during the work week, and what is compensable, what's not. So there's a handful. Those are the handful of them, but the labor and employment world is a dark and murky pond with lots of risks under the water. So definitely having a good advisor on labor and employment issues is critical.
Thanks, Phil. Kevin, so this year, 2022, is brought the same challenges and a lot of different challenges that 2021 and 2020 did for different reasons. I think in our market, though, with our construction contractors, we saw a lot of contractors that are going to have some good years this year. Is there any type of bank that we build up with our surety that we, due to these good years that we've had, to make sure that if 2023 and 2024 are light, that we get the same type of service from them? Or what should we do to make sure? One thing I always go is that, hey, you remember those Q4, and I bet the surety people are smart too, those Q4 distributions you used to take out? How about we don't take those out till Q1? Is there anything like when you look at this bank of equity that we bought up, how do we use that as leverage when working with the surety?
Well, that's a great question, Dennis. I think I would answer that kind of in a big picture way. That bank of equity also includes the relationship you have with your surety. Building up that good relationship over a long period of time really comes in handy and is very valuable in tough times. For instance, we've this last year had one customer who has looked at several very large jobs, and they were frankly stretches for the surety. And when I turned in submitted the request, I wasn't sure whether I'd get approval or not, but we got approval. And the contractor on their own didn't like the job, in this particular case, 2 jobs that they were looking at, and they walked away from the job themselves. Those kind of things are very subtle, but they're things that help build credibility and trust with the surety, so that when things are tough and you need help from your surety has been able to observe your decision-making process and the way you approach your business over a long period of time, and they'll be there for you when you need them. So these are intangible. This is intangible equity that you build up with your relationship with your surety that goes beyond the numbers, because frankly, sometimes the numbers just aren't there. You've had a bad year, you're recovering, and that's when you need the help the most. You need that surety to be there for you. And if you haven't built up that level of credibility and trust with your surety, they might not be there for you.
And that's why you would also use someone like Kevin to make sure that Kevin's able to communicate that level of character that a client is currently performing at, so that the surety knows on there. So thanks to everybody. Thanks to everybody, all the presenters today, Kevin, Phil, Joe. We appreciate your time being on here. I know there's a lot of good knowledge that we shared, and hopefully a lot of stuff that the people on here, myself included, are going to take away and hopefully implement down the road coming into 2023. You can see on the screen on here how to connect with each one of us. If you have any questions that you want to go take offline, or just follow up with us on any item that maybe was unclear, please feel free to follow up with any of us. We'd be sure to help you out, whether you're a current client of Corrigan Krause or whether you just have a question. That's part of the game when you do one of these webinars to help. Plus, we're helping our industry, because I know the construction industry is very important to all of us. Kevin's been doing it for 36 plus years, and he's been a loyalist to a lot of the people that are on here. Phil and I not as long, but we'll be there, Kevin. Hopefully, God willing.
I hope I'm still there when you get there.
So thank you everybody that joined live today. Again, there's going to be a recording that'll stream later. So thank you as well for the people that'll watch that and get to see round 2 recorded. And remember, you can always reach out to us at Corrigan Krause at info@corrigankrause.com. Also, email addresses, like I said before, phone numbers, everything else you can find online for more information. And we thank you again for joining us. And we hope you guys all have a good lunch. If there's any questions, feel free to follow up. And thank you all.
Thank you.